Hello Sector Watchers, welcome to the show. This is the 84th episode of Sector Spotlight for Tuesday the 15th of June, recorded on the 14th. My name is Julius de Kempenaer. I will be your host for today's show, as usual, and I'm presenting to you from Amsterdam in the Netherlands. Thank you for joining me again. My contact details are on the screen, so if there is anything you'd like to share with me, please use the channel that suits you best. Wherever you are located, I sure hope things around the pandemic are improving for you and life is opening up again. It sure is here in the Netherlands. The weather is absolutely gorgeous, very sunny, and temps in the 75 to 80 range and predicted to go even higher towards the end of the week. So we are enjoying summer, finally. Some news from the Dutch sporting desk. Last week, both the men and the women field hockey teams, that's my sport, won the European Championship, so yay. And the Dutch soccer team won its first match in their European Championship tournament against Ukraine. They still have a long way to go, but a good start nevertheless. Back to business. Last week I received an email which had "Does RRG really matter?" as the subject line. Now, if that was meant to be clickbait, it certainly worked, at least it would for me. However, as a matter of fact, it was actually a very well thought out and detailed question based on a real life use case dealing with a lot of actual investor challenges, problems. So after a quick look at recent rotations, I'm going to spend the better part of this show diving into that email and analyzing all the elements, observations, assumptions, interpretations that led to this question. Ladies and gentlemen, this is Sector Spotlight. I'm going to leave out the asset class rotations because we talked a lot about it last week and not a lot has changed. So the few minutes that we have before we start diving into that mailbag segment, I want to spend on the sectors and the sector rotation. On the left-hand side, we have the daily RRG showing you what happened last week. As a matter of fact, up to and including to today. Market's not closed yet, so this is the first day today. And on the right-hand side, we have the weekly. So if we just quickly do an overview of performances, then we see that last week, actually, healthcare was the best performing sector, followed by real estate. And then we had technology and consumer discretionary. Those two are sort of a surprise given their position on the weekly RRG. Utilities at 1.1%, communication services 0.8%, and then the S&P itself came in at 0.4%. And below the S&P, so underperforming last week, were energy, staples, industrials, materials, and financials. Actually, the pretty big spread between the highest and the lowest. So plus 2% for healthcare and minus 2.4% for financials. It's a 4.4% spread. Not the biggest that we've ever seen, but still noticeable. Now, if we go over those sectors and relate them to their weekly rotations, and I'm going to do this alphabetically, that is just easier to follow. We have materials diving into the lagging quadrant, and on the weekly you see it rolling over inside the leading quadrant. So let's say sort of a weakening signal, I'd say, for materials. Communication services coming down on the daily, but not with a very long tail, so very shallow. And well, moving up last week was sort of neutral. But still curling up inside the weakening quadrant on the weekly RRG, so that's a positive thing. We go to energy, then that's rotating back into leading, and that's pretty much leading the rotation on the weekly for energy, so that's still, things look still pretty good for the energy sector, or maybe I have to say are looking good again, because I went through some sort of pause, but that seems to be picking up again. Financials nosediving into the lagging quadrant on the daily, and we see some weakness on the weekly RRG, but the momentum, the downside momentum, seems to be fading. We're now moving lower on relative strength, but we're still, if if you look at the RRG here, the second strongest sector in terms of relative strength if you measure on the RS ratio scale. So still a pretty good sector. Industrials rolling over on the weekly, diving into the weakening quadrant. And if you look at the daily, then you see a move into the lagging quadrant. So the industrial sector is definitely something to keep an eye on, because there at least the relative strength is weakening. Go to technology, as we said, had a very good week last week, but if we look at the tail on the weekly RRG, then that still is inside the lagging quadrant, and it has trouble picking up on the RS ratio scale. As a matter of fact, we're starting to move lower on the RS ratio scale again, and that fits in with the weak relative strength chart and the weak price chart that we still see for technology, despite the recent rally. It's not enough yet to turn all of that around. Go to staples, inside lagging on the daily, and here it is inside improving on the weekly. We lost a little bit, but it's now leveling off and it started moving to the right. Makes it a sector, it's a defensive sector. I put it at neutral. Not a very clear message here from this sector, from these RRGs. Unlike the real estate sector, you see a very long and nice, getting stronger and stronger tail on the weekly RRG, and that's definitely confirmed by the rotation on the daily RRG. So real estate, I think real estate right now, maybe together with energy, is definitely one of the better sectors inside the S&P 500 at the moment. Utilities is like staples, sort of neutral, picking up on the daily. Did pretty good on the weekly, but lost a bit of momentum over the last couple of weeks. So we have to see how this works out. This is sort of a neutral, indecisive type move for me at the moment. And then we have healthcare picking up inside the lagging quadrant on the daily, and the rotation on the weekly. That tail is still doing pretty good. That's if you remember the best outlook based on a seasonal pattern for the month of June, and so far, performance-wise, it has not done the most. So it's up 8.2, which is still below the S&P at 8.7. So halfway through the month, but the tail here is still promising. We're still on the right track. So let's see how this works out over the last 2 weeks of the month. And then finally, we have the consumer discretionary sector on the daily, inside improving but rolling over again. And if you go to the weekly, then I think we agree that this is a very weak position for the discretionary sector. And that continues to leave us with the fact and the observation that both tech and discretionary are still the weaker sectors, and they are at least preventing the S&P from rallying significantly. It's every day, it's like a little bit up, a little bit down, it's not very massively. Good rotations for real estate and energy, and definitely weaker rotations for technology, industrials, discretionary, and materials. So all in all, I still keep a cautious approach to the market and to the S&P as a whole. That's it for the update. We're going for a quick break, and after that, the mailbag segment. It's been a while since we discussed some questions that came in through the mailbag. I have a few waiting and sitting to be answered, and I need to find the right time for that. But very recently I got an email from Earshot, which attracted my attention for sure, especially because it was a very was he calling out RRG? I don't know. It was, but he gave a very detailed description of what he was trying to achieve using RRG, and it didn't work, and he was questioning, was it RRG that failed or maybe something else? And I think that's a very interesting question because it actually deals with a number of questions that investors have to look at, have to deal with, because it's not only coming up with an idea or looking at a chart, it's also translating that information into a position. And Irshad is using options, which makes it even more complicated because you got a lot of different ways to use options and a lot of different combinations that you can make. So let's start with so that's the reason why I thought it was a very good question to answer, because I got a lot of those and all of them make sense. And I will answer, probably everybody by now should have had at least an emailed response to any questions. And some of those questions I am saving for mailbag segments in future shows. But let's have a look at Irshad's question first before we dive into what's going on and peeling off the various layers of the question. So here's the question, and obviously, as you can see, the subject line is a teaser. Does RRG really matter? Answer to that is, of course, yes. Just kidding. It should start with, hello Julius, don't be offended by the email subject. I want to present a real case where I followed RRG religiously and it did not work. I think it should be, I'm not sure if my application of RRG was wrong. Now, first of all, Irshad, don't worry. It takes a lot more to offend me, and I mean a lot more. So don't worry about that. And actually, I like a thought-provoking approach, and trying to look behind what's going on and figuring out, different angles of a subject, of a problem. So no problem at all. Here are the details. Appreciate if you or your team members can tell when things went wrong. So what are the steps that Irshad was taking? First, I use a 1-year daily sector chart from StockCharts. On the 25th of May, XLY and XLK showed up in the improving quadrant of RRG. Third step, filtering XLK, I selected NOW and SWKS as candidates to trade and bought 2 weeks options expiring on June 11. The reason to 2 weeks option expiry was a typical trend last for 4 to 11 candles. Both trades lost. I closed NOW a few days ago. Expiry, see no signs of improvement. I think it should be before expiry because I see no sign of improvement. While all of this happened, both NOW and SWKS stayed in the improving quadrant instead of going down to the lagging quadrant. Now, with all of the above, is my question, does RRG really matter, or am I barking at the wrong tree? Let's go through this step by step and see what we find and see what we can say about it. First of all, I use a 1-year daily sector chart from StockCharts. Of course, we can actually mimic that. Start here, bring up an RRG, sectors, 1 year daily, and the story starts on the 25th of May. So that is right here. Let's fit it. Now, right away I see something strange because Irshad writes that both XLK and XLY are showing up in the improving quadrant. I can only see XLK showing up in the improving quadrant. XLY is still inside lagging, but it started to move up. Now, before we go any further, the RS ratio is the most important axis. That's pretty much the ranking axis, so to say. So XLK and XLY are actually, on this daily RRG, the two weakest sectors. They're picking up in momentum, but compared with the rest of the universe, these are the two weakest sectors in the universe. Let's start with that. Doesn't have to be a problem, just an observation, because their heading is good. The heading is strong. It's moving in that, well, at least for XLK, into that 0 to 90 degree heading, and XLY seems pretty close to doing that. So XLK, yes. XLY, I don't know how he said that it was showing up inside the improving quadrant, because I see it inside lagging, as you can see here on the chart. Now the second thing is filtering for XLK. So he went with XLK and forgot about XLY, which is good for us because we don't have to dive further into XLY and figure out why it was not an improving, etc. So we're focusing in, we're zooming in now on the technology sector, on XLK. And Earshot selected NOW and SWKS as candidates to trade, and he bought 2 weeks options that were expiring on the 11th of June. And the reason for 2 weeks option expiry was a typical trend last for 4 to 11 candles. Now, here is one issue, quote unquote, that I have, and that's the statement. The reason for 2 week option expiry was a typical trend last for 4 to 11 candles. Where does that come from? A typical trend lasts for 4 to 11 candles. There are many different trends, and I'm not sure whether this is... I have no backing for that. What I always try to tell people when I talk about RRG, because RRG is all about relative trends, that's another thing that's got to be very important in this case. RRG looks at relative trends, not so much at absolute trends. So, but my sort of rule of thumb that I've always used presenting RRG is for weekly RRGs, the typical duration of a trend, the typical move, is a minimum of 3 months. So that is like 12 weeks, right? 3 months, 12 weeks, something like that. If you translate that to a daily RRG and you take 3 weeks, then that would mean 15 days, roughly, as a rule of thumb for a duration of a trend. And those are pretty much bare minimum durations. So I think that these trends, especially on the weekly, they tend to last much longer than we usually assume. But on the weekly, I use 3 months, 12 weeks, and for the daily, I sort of use as a rule of thumb 15 days, 15 trading days, 3 weeks. So that's where we are sort of diverging a little bit in terms of approach. Second of all, options obviously is a means to translating a view into a position, and that's what investing is all about. And the reason why I wanted to use this case is because it is so important to use the right instruments and to apply them correctly to benefit from your view. So basically having a view is one thing, and translating that into a position and creating exposure to that view is a completely different thing. I've mentioned an article that I wrote about that quite some time ago already, and the title of that article is Market Analysis and Portfolio Construction are two completely different animals in the same zoo. I'll post a link in the comments section, but I think that article pretty much goes down into this problem, into this issue. So 2 weeks options means that you're really short-term trading, or at least in my book. That's a pretty aggressive trade. So it's a pretty short-term trade. Now Earshot says that he filters XLK. So we went into the members of the technology sector, and he selected NOW and SWKS as candidates to trade. Now he didn't write what he was calling, he was buying call or put options, and he didn't write what the strike price was. And with options, those values, those data, that information is absolutely crucial for your success. So I am going to assume that he was buying calls, so we're trading call options. And for the strike price, I don't know. I got a guess, but we'll get to that later on once we see the figures. We may be able to do an educated guess with regard to the strike price. So let's have a look at NOW and SWKS on the RRG on the 25th and on the 11th of June. So go back to the RRG, and we're going to bring up the technology sector members, and we're going to go for a daily chart, and we're going to update. Now it's pretty crowded, so I'm going to single out, find NOW, and we're going to scroll back to the 25th of May. So that's here. NOW at that point in time just crossed into the improving quadrant. Again, a pretty aggressive trade, but that's okay because Irshad's, from what I detect from his email, is a pretty aggressive trader looking for short-term opportunities, short-term gains. And this definitely looks like, for a very aggressive trade. Again, remind you that XLK was far on the left-hand side of that RRG, which means that it was, weak compared to the rest. And NOW is very low on the RS ratio scale as well. So that's also a weak one. But we're trying to pick up, we're aggressive, so that's all good. Now, NOW at that time was trading at let's say 480 US dollars. Now let's see what happened until expiry. So it's the 25th of May, and then we go to the 11th of June, and you see that NOW accelerated a little bit, rolled over, started to move to the right, and it's ending on the 11th of June, it's last Friday, at 498. That's a gain of $18. So it went up, but the trade still lost. And I think that tells me something right there on the strike price. Because when you buy NOW on the 25th, or when you buy an option on NOW on the 25th, so here on the 25th, NOW was 480, roughly 480 US dollars. And let's say that you bought a call option with a $500 strike price. Then, expiring at 498 after 2 weeks means that option expires worthless. And you have a losing trade. Is that the fault of NOW? Is that the fault of RRG? I don't know. It was a pretty aggressive trade, but it still worked out well. We gained 18 bucks. So for this one, I'm going to assume, going to detect that it was a strike price issue. Now let's get to the other one, SWKS. SWKS, Skyworks Solutions. On the 25th of May, SWKS, again, similar pattern, so I can totally understand the view here, albeit very aggressive, but still, I mean, it's the technology sector is moving into improving, and these stocks are moving into improving. It's trying to capture that early stage turnaround. SWKS at 170 US dollars on the 25th of May. And then in that 2 weeks, and I don't know when he closed that trade, so we're going to assume that it's going to the end, to the expiry of the option, on June 11. And then from 170, SWKS went to 171. So that went up $1 and a little bit. Not much, but still, it went up. And it's still inside the improving quadrant. Let me highlight it. So again, it went from 170 to 171. If the strike price of the option was anything above 171, say 175, 180, that trade would have lost. Because, you know, the option expires worthless. The ideas were actually pretty good, at least in my view, they were pretty good. Let's have a look, because I actually have aggregated them on a spreadsheet here to get all the information right there. If we recap this, XLK was at 138.65 on the 25th of May, and on the 11th it was, let's say, 142. That means a 2.4% gain. XLY actually also gained a little bit, but that was sort of left out in the whole equation. And if you look at the benchmark, SPY gained 1.45%. So XLK, despite the fact that it was far on the left, but it was in the initial move up, actually outperformed SPY over that very short period of time. Now, if we look at the individual stocks that Earshot picked, then we have NOW, which was at around 480, and it moved to 498, gaining almost 3.8% over that 2-week period. And that actually, it's beating XLK, but it's also beating SPY. So it was a pretty damn good pick, Earshot. You nailed it. You had a very good call on the individual stock price. Now, SWKS didn't move maybe as aggressive as expected, but it didn't lose money either. You know, so you picked it up, maybe not much, only 0.6%, and it was underperforming technology and was underperforming SPY. Nevertheless, it was a winning view. You had a winning market view. So wrapping this all up, let's go back to your email. Where did it go wrong? I think from the information that I have and from what I can see is that where it went wrong was with the translation from a market view to a position. And I think that although the market view was fairly aggressive, but that's fine, RRG lends itself pretty good to making those under the radar very aggressive calls, as long as you know what you're doing. But the translation to a position using 2-week options, most likely with a strike price that was too far out, the translation was too aggressive. So I like the approach. I think it was good. You picked 2 stocks that were showing all the right things on the RRG, but the translation to a position was too aggressive, and that's where it went wrong. If you just would have bought outright cash stocks, you would have gained in that 2-week period. Or if you still want to stick with options, with those types of very aggressive trading, what I would do, and I'm not saying that it is the best way, but what I would do is I would buy in the money or deep in the money call options. Because in a 2-week option, the time decay has a big impact. And if you're buying out of the money call options, then your time decay can go against you very, very rapidly. You do need a very aggressive and a very big move in absolute terms to actually make that work. If you would have bought NOW or SWKS deep in the money with that 2-week horizon, you would definitely make money on NOW, and SWKS maybe a little bit, but you would have at least broken even or maybe a small gain. So to wrap it up, good strategy, good view, good picks, implementation, construction with the 2-week options, and the probably too high strike price, too aggressive. That's my take on it. I hope it helps. Hope it helps you, Earshot, and I hope it helps many other people who are trading options. And that concludes the show for today. Please leave us a comment or a like if you have anything to share. And otherwise, I hope to see you back next week at a new episode of Sector Spotlight. Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.